Ladies and gentlemen, welcome back to the conference room for the fourth session about structural change in the global economy and its meaning for emerging markets. This session is jointly organized by the Policy Center for the New South, the Reinventing Bretton Woods Committee, and UBS. Please welcome to the stage the moderator for this session, Massimiliano Castelli, Head of Strategy and Global Sovereign Markets at UBS Asset Management. And the speakers for this session, Min Zhu, Vice Chairman at the Center for International Economic Exchanges. Leonardo Villar, Governor of the Central Bank of Colombia. And Julio Velarde, Governor of the Central Bank of Peru. Massimiliano Castelli, the floor is yours.
Thank you. Thank you very much. We are missing one speaker, one panelist, but we hope he will join us in the next few minutes. So, we talk about emerging markets, and first of all, let me introduce myself. My name is Max Castelli. I work as Head of Strategy in Global Sovereign Market, which is the team within UBS Asset Management serving central banks, sovereign wealth funds, and what we call official institution in the jargon. And my role is, of course, to be a moderator, and I thought normally I open with some remarks, and then I thought today what to do is to share with you what we are discussing with central banks, with reserve manager in this venue. For us, the IMF World Bank meeting is not just a place where we can hear about the latest news from the IMF or from policymaker, but it's also an opportunity to do what we call speed dating. We have something like 45 meetings in a matter of 3-4 days with central banks when we hear what is the latest thinking about, in particular, reserve management. And one topic, of course, of conversation that we have with the central bank at the moment, of course, is fixed income. As you know, we are in a world of higher yields. Fixed income is back. There are different ways to say that. But it's very interesting that already in the last few months, and now even more today here in Marrakesh, I'm hearing many central banks, when they look at their investment portfolio, looking beyond the government bonds of advanced economies. They start to look at emerging market debt. It can normally in our currency, probably because they don't want to take the exchange rate risk, but there is an increasing interest about emerging market debt. And this is not only about the high yield and the premium that you can generate on this asset class, but it's also about the fact that many central banks, like I would say investor alike, are surprised about the resilience of emerging markets over the last 2 years. In the face of rising dollar, rapid increasing interest rates, actually many emerging markets have been doing remarkably well. They've been very proactive in introducing a restrictive monetary policy to stem inflation. Some of them have almost, I would say, mission accomplished, and they're almost on the way to decrease interest rates. So there is a nice story around the emerging market. Of course, I don't want to generalize, but I thought this would be the best way for me to open this conversation by giving you the private sector, the investor perspective. And of course, about what we are here today is to hear from our guests. I will, they've already been introduced, and I asked them to give a little bit of and some introductory remarks, and then I would like to open to the floor. And I asked them fundamentally 2 questions. First of all, of course, looking at their own respective countries, how they have been dealing with the challenge of the last 2 years, in particular rising interest rate in the US, and very strong dollar, and of course all the uncertainty that we know existing at the global level. And then I ask a second question, which would be more about the current challenge, which are not only economic, but I believe are also geopolitical. We think about what's going on in terms of deglobalization, the whole reconfiguration of international value chain. We know there will be winners and losers, so it would be good to hear directly from them, from their perspective as a policymaker, how they see the current challenge and how they see the future in particular. So 10 minutes each. So without further ado, I would like to pass the floor to Min Zhu. for his opening remarks.
Yeah, I think it's a walk. Thank you. Well, thank you very much, first of all, for the invitation. It's a great honor for me to be here, say a few words to this very distinguished audience. Your first question, I think emerging market dealing the current sort of a secular change very well. I mean, the few things, number one, the emerging market did a very reasonable, moderate stimulus when COVID came, much smaller than advanced economy, right? Roughly half of their size. And then number two, emerging market, tell the inflation increasing earlier, so they take action earlier. I think this is also important. I think emerging market central bankers take interesting raising actions much earlier, faster than Fed did. I think Fed clearly is behind the curve, but emerging market doing those things very well. So we'll be able to manage the inflation and also anchor to a certain degree of normalities. I think this is very good. And meanwhile, now they focus more on the growth, because they still have, given they did not do a huge stimulus in the early days, so now they have time to and space for a further stimulus to support the growth. I think those are the very much central bank focus. So overall, I think emerging market handle the policy structure change quite well. Capital flow in dollar is very strong, but yeah, overall the system showed resilience. Yeah, I'll stop here.
Thank you. I would like then to pass the floor to Leonardo Villar, Governor of the Central Bank of Colombia.
Thank you very much for the invitation. And I will start by saying that we have been subject to very strong shocks during the last few years. And what is, as you said, is surprising is how resilient many of our countries have been to those shocks. It is true that we have inflation relatively high, and still, in our case, we have inflation much higher than the target. But inflation is coming down. We expect inflation to go down to the target in the case of Colombia by the end of next year. It is still above 10%. But we have had 6 months with inflation going down, and the expectation is that we can be around 5% or below 5% in 1 year time. And that is in a context in which we have tightened interest rates and monetary policy very strongly. We increased interest rates during the last 2 years by more than 11 percentage points, by 11.5 percentage points. And what is surprising in that context is that the economy is behaving relatively well. We recovered after the pandemic. We had with a very strong growth in 2021 and again in 2022. Already in 2021, we grew by 11%, and we recovered the level of output that we had before the pandemic, despite a pandemic which implied a recession with a decline of more than 8% that year. But we continue growing in 2022, and it is very clear that in that year and now, we have a level of output which is well above the trend that we had before the pandemic. I mean, without the pandemic, we would have today a level of output below the one that we have today. And we will grow this year by only 1%, which is, implies a strong adjustment that will help us to reduce inflation. But what is in some ways surprising is that we can do that. We still have a level of output that will be above trend, and we will be able and people believe that we will be able to bring inflation down to our target in 1 year time or something, perhaps a little bit more than that. But that shows resilience, and that resilience, I think, comes from the fact that our countries, at least in the region, have had very strong policy frameworks, and we have been able to undertake strong monetary policies, and at the same time we have had some adjustment in fiscal policies that in the beginning with the pandemic were very easy, very relaxed, implied very large fiscal deficits. But today they are adjusting and they are helping the process of tightening monetary policy. I will stop here.
Thank you very much. Maybe I go before to Kashima, and then we come back to you, Governor Velarde, so we have different geographical perspectives. Sorry. Thank you for, you made it. Thank you very much for being with us, and it would be great to get your perspective from South Africa.
Can I just, I want to get a flavor of the conversation. Anything particular you'd like, you've been discussing, so I can be relevant to what I say about South Africa?
Tell people your secret. When do you raise or cut interest rates?
Oh, it's as simple as that.
How much? See?
Yeah. Okay?
Yeah.
Is that good enough? Yeah, so apologies for this. I've had the most unusual off-the-beaten track 2-hour tour of Morocco into alleys that I ordinarily wouldn't have gone into, so the taxi got totally lost. Yeah, well, I guess, I often used to say it's often very nice to be on a panel with our Latin American colleagues, because South Africa is kind of an African country with Latin American characteristics. Unlike most of our colleagues in Latin America, we have a slightly higher inflation target, which is 3 to 6%, with a midpoint of 4.5%. Inflation hasn't, we've had, like most people, we started off, we brought our interest rates down to 350 basis points at the beginning of COVID. We're now at 825, and inflation is coming back close to the midpoint of the target, obviously recently interrupted by oil and the persistence of food prices. But I think that the real challenge, if you think about many Latin American countries has been extremely preemptive. We were slightly less preemptive, partly because we were not deviating as much from the inflation target as many other countries quickly were, maybe slightly higher target. But I think that the main challenge we've had is how the ability to implement monetary policy has been constrained by monetary policy spillovers all over the world, and how we needed to rethink that trade-off. And I guess the real issue is a simple one, and that is that pre the GFC, I think that non-resident ownership of South African bonds were in the vicinity of about 10%. In the pre-COVID, that shot up to 40%, which meant that a success story of a country like South Africa is that you had massive search for yield, massive non-resident interest in what was considered very deep liquid markets. But within that, you also had built-in vulnerabilities. So because we became so dependent on non-resident investment of our bonds, and there must have been many positive spillovers for that, maybe compressed yields and so on, given the demand for the bonds. But the moment you had US interest rates going up, that success story was quickly reversed. So we're currently, from a peak of 40% non-resident investment, ownership of South African government bonds is currently in the region of about 20%. And it is the fixed income market, movements in the fixed income market that's caused havoc with our exchange rate. While we don't respond to the exchange rate, we make some pretty strong assumptions about the impact of a depreciated exchange rate on inflation. We demonstrate why we think that persistent depreciation is going to give you second-round effects. And in the process, that's where we are at. Currently, we have an estimated nominal neutral rate of about 7%. The actual repo rate at the moment is 8.25%. We've kept it unchanged in the last two meetings. Big fights amongst MPC members, but we kept it unchanged. And the real question I think that we face is that given the recent round of shocks, the question of cutting gets kind of postponed more and more because these multiple shocks tend to persist. So let me stop there, and I'm happy to come in whenever. Thank you.
Thank you very much. We finished the first round with Governor Velarde. Thank you.
Thank you very much for the invitation first. It's something that was said almost at the end. That word has been used in advanced countries to very low inflation. The 90s, the great moderation. After Lehman, we had such low inflation that I believe many people believe it was permanent. And for many of the traders, probably they believe that interest rates should remain like the levels we saw since September, October 2008. I am saying this because now we have seen the yield of the bonds, the treasury bonds increase, of course more before the problems in Israel. And I believe people are saying short-term stories. Less people are buying. China has less surplus. They are buying less. There is too much debt. They are issuing because of the almost closure of the government. They have been issuing too much paper, the Fed. But probably I believe part of the story is that we have to get used that maybe the rates are going to be higher. People have been thinking that probably we will return to the level of 10 years ago. But maybe the scenario is more the one of 20 years ago, where the interest rates will be much higher. Then the equilibrium 10-year bond will be much higher. The neutral rate will be much higher. Although John Williams, the Fed of New York, continue arguing that the neutral rate is 0.5, you already have the Fed of Richmond saying that it might be almost 2%. So probably all the structure might be higher. And not only that, I was talking about a long period of low inflation. The inflation has been below 2%. It's not, they are not going to change the target. Probably the inflation will be more close to 2. So we'll have PF star probably higher, inflation is slightly higher, 20, 30 basis points higher. So the equilibrium will be much higher. I am saying this in connection to what the Deputy Governor of the South African Central Bank was saying. We are at the top of the inflows, right? The difference, that it was part of the comment of Mr. Castelli, is that before it was very hard to lower the interest rate too much. Before the announcement of the taper in 2013, we had 61% of our bonds in domestic currency in the hands of foreigners. Of course, after the announcement of the tapering, that has been reduced, increased, but what is different is that between 2009, March 2009, 2013, May 2013, every emerging market received so much money, and of course we suffer afterwards between 2014 and almost March of 2016, the reversal of that inflow. It was not only inflows, it was betting for appreciation. It was betting with derivatives. Of course, that changed completely. Now the situation is not so terrible. After the tapering, after the normalization 2016, when they started betting the curve were more neutral, there had not been such big inflows. So they are not going to be also not big outflows because they were not big inflows. So the conditions are probably less disruptive than what were before. In 2012, you have asked me, the situation for emerging markets would have been much worse. And yes, we have been preempting not only Latin America, Eastern Europe. We were within the first to increase interest rate. Brazil was the first in the region. In our case, we increased, after 2 months, we were outside the target. We started to increase in August, 2 weeks before the speech of Powell in Jackson Hole saying that inflation was temporary. No, that's not. And we continue increasing almost every month until the start of this year. We are at 7.25 now. We increased it until January, then we made a long pause. And in the last 2 months, August and September, we have reduced 25 basis points. Our inflation is still pretty high, 5%. Our target is 2 plus minus 1. But 5% because of food. Well, in many countries, Brazil, for example, I don't know, South Africa, but inflation, or in the States, food inflation has been coming down, has almost disappeared. That's a contributing factor. In our case, because of weather factors, and it has been important. Core inflation, which is what we expect it to be within that target this year. Are different from other countries, core is much below headline. Core now is 3.6, we expect it to be slightly below 3% at the end of this year. Headline inflation probably next year, depending on weather. Unfortunately, food has been affected a lot, and there is strong probability of El Nino, which might affect prices a lot. But what I would say I would say Latin America is Europe. I have reacted pretty quickly, pretty fast. They increased the interest rate a lot. Most of the countries, of the bigger countries, only Mexico and Colombia are still on hold, but most of the other countries have started reducing the rate. What I have seen even at breakfast, where we were Leonardo today of South American central bank governors, is they are going to be cautious. As the Fed is going to be cautious. Everybody wants to be sure that inflation is controlled, that inflation will return to the target. Everybody is confident that inflation is going to come down. The discussion might be how long it takes. Everybody is confident inflation will return to the target. The discussion is when. It might be a little bit longer, etc. But I believe that most of the central banks are not only committed to inflation, but committed to a path to be cautious while inflation is coming down. Thank you.
Thank you very much. So let me, after this first round, just also to then eventually open to the floor. So resilience, we all agree that there is more resilience than it was the case in the past, very important. Then I also hear, let's say, the same music that we hear in advanced economy, that we are going to be in a higher yield environment for a prolonged period of time. We call it a higher for longer, just to give a sort of a funny name to everything that we see. But I also heard the two additional things. One is commodity price, how much this continue to impact in different regions. Actually, there is this chapter of the IMF World Economic Outlook, which is entirely focused on that, which I also find very interesting. And the question then become a little bit more about what next. Maybe before doing that, we do another round. Is there any question from the audience? I mean, I like to make it as interactive as possible. If there is any question for our speakers on what you heard so far. Maybe you want to introduce yourselves just for... Thank you.
Me? Yes. Yeah, Thomas Delabre, H2 Asset Management. Good morning to everyone. Yeah, I have a question which is more looking forward about inflation, the landing zone of inflation going forward. You know, it's pretty sure that the disinflation process is well underway. And where this inflation is going to land, I think it's true for developed market and emerging market economies, where it's very likely that it's going to be landing at a level which is higher than the previous cycle, for different reasons and arguments that have been, putting forward in many times, reshoring, commodity prices, geopolitical risk, and so on and so on. So I guess if I were a policymaker, I would be asking myself about the inflation target regime and which kind of inflation target I should be targeting. If I think about a country like Brazil, does it make sense still to target 3.5% as a target and to get into a restrictive position as a monetary policy maker, and maybe to put my country into some kind of strain in terms of economic policy for factors which I'm not really in charge of, like commodity prices and so on and so on. So I guess this clearly applies to many emerging markets, economies, but also to the Fed from that standpoint. So I would like to have your sense about that and how you move from one regime to another, because the transition might be a bit painful for policymakers. Thank you.
If there is any other question, maybe we take two and then we have a round, everybody can comment on them. Please. Oh, sorry. I thought you had the microphone on the table. Yeah, you have it indeed.
Hello, Reda Hashimi, CEO Capital Quant, ici. So I have a basic question for the governors. So in the era of AI, digital, and also analytics, how is your organization actually considering taking advantage of these disruptive and innovative technologies to improve some aspects, for example, financial stability and better control inflation, as well as better monetary and financial policies? Some insights possible.
Bin? So we have two questions. One is about inflation and monetary policy regime and targeting. Whether I guess the first question we should ask ourselves: do we have the right regime or not? And eventually, should we change it? And the second one is more about the impact of digitization on central banks and monetary policy and operation.
Yeah, let me jump to the first one because it's easier for me. Because this is a basic question for central bankers. I was, but I'm not. I'm retired. I'm free. So let me try to say some words for them, so it makes them little easier. You're right. I think the inflation will stay there relatively higher than whatever we have. I can see since 2008, we have a low inflation, low interest rates, almost zero interest rates, right? And the median growth and high debts, it's all gone. I can see in the next 5 years, we're moving into the rather high inflation, high yield, and the low growth, but the very high debts. So it's a completely new normal. I agree with you just said first part. I think that's a real challenge. That's a real challenge for emerging market. For US, I see US inflation probably will stay there 3 and 3.5. Interest rate have to stay with the 4 and 4.5. Keep the net interest rates 1%, and the growth will drop down to 1, no more than 1.5. If the US that way, you may disagree. So you're a European bank. And so that's have a huge impact on the emerging market because the dollar will be very strong, right? I also can see because that issues, the gain moving away from interest rates to bonds market, which is your point. I think the interest rates more or less will stay relatively high, but the bonds yield can be very volatile. Can be very volatile because it depends on supply and demand. It depends on the capital movements. So I think that for next 12 months, the bonds market, the year of a bonds market, the currency market will be a new game. So then go back, if that's the case with the central bank, your question whether we move to new regime, how can it move from old to new? I would say central bank will not move the target. They will stick on the target 2%. Because so many studies says, inflation will stay high, but gradually, after next year, gradually coming down, and particularly commodity and the growth is weak. So we'll go back. So they will not change the regime. So they will try to use a policy rates to handle the inflation rate, more or less stay in the range. And I do believe in the next 12 months, the inflation and the interest rates probably will be in a stable position. But real volatilization is in the bonds market. It's in the currency market. Yeah, I will stop here.
Governor Velarde wanted to.
Yes, please. Well, first point, probably there are some factors, energy transition may push in prices in higher inflation. I don't know how important it is going to be on prices, but what can I say when this issue has been raised, not within central bankers, but in meetings where there were central banks and bankers have asked if they believe that the inflation target should be higher. The answer has been almost unanimous. Nobody's thinking about that. What can happen in Colombia, Peru, many countries have had not a target on a point, but a range, different from the States or from Europe, where they have 2% in the case of the United States. What can happen once they establish a lower inflation, maybe they can go to 1.5, 2.5, or 1.3, I don't know. But just after they have reached inflation. Second, I don't see any clear advantage of moving the target. Probably you will increase inflation expectations, and you won't get almost any benefit at all, except this accommodation of these prices for energy. Things will be the same with the higher inflation. And we don't care about the number 2%. We have 2%, Euro has 2%, the States, a lot of countries have 2%, Colombia, Chile, 3%. People want low and stable inflation. And probably inflation might be around 2.5, 3. The numbers, probably some people say 4, 5, are numbers that the people are not thinking with what they want, low stable inflation. If you ask a Moroccan, American, a Colombian, what's the inflation rate, probably they don't know. The only thing they care is inflation is rather low and stable. But the numbers, people are, just to finish. Remember Argentina. When Federico Sturzenegger, the governor of Argentina, was forced to increase the target, he not only didn't obtain growth, he only obtained much higher inflation. No? Thank you.
Thank you. Well, I will start also with the first question, which is how can be the transition towards the new normal, or the recovery of a normality with a low inflation? And I would say that my first intervention was based on the idea that we have managed to be resilient after very strong shocks. And that may be understood as if we had no very, very, very strong challenges today. My intervention now is the challenges are huge. And the challenges towards bringing inflation down to the target, and dealing with the topics like the ones that have been mentioned here of high interest rates in advanced economies and higher for longer, perhaps. Commodity prices that can be very volatile in the international context that we have today. And inflation, which is still high, implies that we will need to keep very contractionary monetary policies in a context in which the economies are decelerating. So what I presented in my first intervention is something very positive, that we are managing the situation, cannot be understood as a lack of difficulties ahead. What we will have in the next year or 2 years is a situation in which inflation is very likely going down, but economic growth is very low. It's very likely that we may have quarters in which growth is even negative. And we will have to keep contractionary monetary policies in order to guarantee that the inflation target is reached. And why is that? Because all the framework, the policy framework that we have in the central bank is based on our credibility. And the credibility in an inflation target that can be accomplished. And that credibility is hard to recover after we had 2021, 2022, 2023 without getting to the target. We have to do as much as we can to bring inflation to the target in 2024. That is the case of Colombia, perhaps. Julio in Peru can do that before that. But in our case, that will imply that the reduction in inflation that we are expecting from now to the end of next year will be the largest reduction in inflation in the Colombian history. So that is a very strong challenge that will imply that we will not be very popular in our countries, that we will have to keep very high real interest rates, even if we are able to reduce the nominal interest rate at some point when inflation shows a decline. But keeping, in any case, a tight monetary policy, a tight monetary policy stance.
Thank you. It looks like nobody wants to tackle the digitization question.
Hello. Yeah, I'll come to that. Let me just add one thing small. I mean, I agree with my colleagues. In the case of Peru, Colombia, we're talking about a 2% target. But on average, the inflation rate in emerging markets is about 3%. The inflation rate in advanced countries is 2%. One of the very good reasons why, on average, emerging markets have a higher inflation rate. You're dealing differently. Your exchange rate pass-through is often higher. You're dealing with bigger baskets of food shocks in your basket, so you're more sensitive. So in that sense, I think that having a slightly higher inflation target in some of the advanced countries, emerging markets, makes sense. But I think that most people more broadly think about 2-3%. We're an outlier. We're at 4.5%. And we actually, looking at what would the sacrifice ratio be of bringing inflation from 4.5% to 3%. And it's an interesting dynamic going on here, because at one level you could say, in a country like South Africa, most of your inflation comes from government administrative prices, like energy, municipal rates, and so on. So should you keep your inflation target at 4.5% to accommodate this, or should you make the assumption that by keeping it by 4.5%, you're not going to have admin prices move down? You're almost allowing admin prices to rise above the inflation target. Big debate, but I'm not going to get into it. So, many central banks have, in response to digitization, set up kind of in different forms and guises R&D departments. In my central bank, an R&D department would be a department that deals with AI. It would be a department that looks at digital currency, all aspects of digitization. And I think that there's a lot to absorb. At one level, we are exploring the case for introducing a central bank digital currency in the wholesale market, in the retail market. At another level, the question of AI has a number of facets to it. The one is, can it really be the additional member in the Monetary Policy Committee compared to current forecasting models? I think that the analysts are using and experimenting with what AI can do. Some of us, instead of going to our staff and asking for a report on a conference we'll be attending and speaking on, we play around with ChatGPT, but it doesn't quite give you what you need. So I don't think there's anything profound or substantial that I could say, certainly from the South African Reserve Bank. But like everyone else, I don't think we're at the frontier. We learn from other parts of the economy and society that spends more time thinking about AI than a central bank could do. Some central banks may be on a different planet, but certainly not us.
Thank you. Let me now move one step ahead. So we talk about CDBC, and actually just to mention that in the agenda there is a nice session on CDBC coming up in the next few days, which this topic will be discussed, because I think it requires really to go deep on the technicalities to understand it. But let me talk a little bit about the future here and the future challenge. I mean, inflation, I think we all agree that is still a big challenge, which has not been It's not over yet, and I think the message is clear. Central banks will do what is required to bring it down, even if this makes you unpopular in your country. But let's say looking a little bit at the broader landscape, and there is a lot of talk about fragmentation. We see it seems that we move from one geopolitical hotspot to another, right? There is always a new one coming up. And now the latest one, of course, is the one that we had in the Middle East, which impact commodity, which ultimately also impact inflation. So from your perspective, from your region, this new sort of word, fragmented, I don't want to use the word deglobalization because it's a little bit inflated, but this new geopolitical environment we are living in, does it change the way you, first of all, run your monetary policy? Maybe by becoming more cautious or becoming a little bit more aggressive because you need to do more, you need to be stronger at home in order to deal with this external challenge. And also for the economy as a whole, more from a real economy perspective. Do you see these more the opportunities, or do you see more the cost of this new reality? I think it's very important for emerging market, this new perspective. And please feel free to jump, anyone who wants to jump.
I think in our case, the impact of fragmentation, of trade fragmentation, is clearly negative. I can imagine that for some very specific countries like Mexico in Latin America, there may be an advantage of fragmentation in the sense that it is so close to the US that there is a possibility of moving some activities from Asian countries to Mexico and having then as the supplier of some special items or cars or so on in the US. But besides that, perhaps in Mexico or in Central America, I don't see that happening in the case of South America. My feeling is that the fragmentation of trade is something that will reduce productivity, that will reduce the possibilities of growth in the long run, and that may affect our potential growth, and also may imply that the real interest rate that we need in the long run is higher than the one that we used to have. So in that sense, I don't see a mechanism that will change the way in which we manage the cycles. But I see a possibility of very strong cost out of fragmentation for the long term in our region. And I just want to take advantage of the mic to say something about the digitalization. Because I think the digitalization is part of the mechanism by which we can improve productivity in the future. But my very personal feeling is that we have talked too much about the possibilities of central banks doing a large part of the job in terms of technological development. And my feeling is that we have to rely more on the private sector. And the private sector has been very active, very successful in producing better technologies. And the role of the central banks is not to compete with them. And I think I'm not convinced that any CBDC, any specific technological mechanism issued by the central banks will help very much in the process of improving digitalization. Very different is the idea that we can work in the process of helping the private sector or even pushing the private sector to make the process of digitalization more interoperative, more interactive, to guarantee that for instance, instant payments develop in an interoperable environment, that banks can use the best technologies, but without trying to replace what the traditional banking sector can do.
Would be complementary. Please.
Also, the governor from Colombia said, I think geopolitical is absolutely negative for everyone, for the whole world, for everyone, because it's increased the cost. Now, it's very clear the global resource location have two forces now. One force is very much the market force, driven by the efficiency, is a global location. But second is a political security force, right? It's also detour from the efficiency. And things change quite a bit. China used to be the largest US import country for years. Just in the past 10 months, China become the fourth, right? And Mexico become number one, and Canada become number two, and the Europe group will become number three, China become number four. I mean, they're not only market force, there's more, geopolitical force play the role, which is globally effective location, not necessarily. So I think it's a very big issue. Fragmentation will further create the big cost for the whole world. And how do we deal with those things? And for central bank, a direct impact is the fragmentation will increase the cost, will push the inflation even higher. I think that's the one reason of inflation will be high in the next 5 to 10 years. That's also the new challenge for the central bank.
I guess there's two ways one can respond to this question of global fragmentation. The one you could say that this is a fundamental change in paradigm. Central banks have to wake up to a new challenge. On the other extreme, you can say, at the end of the day, if geopolitical risks increase, central banks are borrowing. At the end of the day, you've got to ask the question, what does it mean for financial markets? What does it mean for the transmission mechanism? What does it mean for the traded or the goods sector of the economy? And how does this fragmentation take you in either direction? Productivity declines, world goods import prices go up, and so on. So, at that level, in the mechanics of it, is kind of pretty straightforward. I think what has really been interesting in my country, South Africa, is that we bore the brunt of geopolitical risk in a very serious way. There was an incident in South Africa where the American government was concerned that a ship docked in a very nice little town in the Cape Town called Simonstown, and the allegation was that that ship picked up arms to go to Russia. And the central bank, I think, a couple of weeks after that, had its monetary policy committee, and it had to pay. The country paid the price of enormous volatility in the exchange rate because of the perception that South Africa was putting in its lot with the Russians rather than the Western world. And you kind of
sanction risk material.
Yeah. And then you ask the question, how do you, as a central bank, incorporate geopolitical risk into your models? How do you think about it? In a sense, geopolitical risk is a second-order effect. The first-order effect is what is geopolitical risk to the exchange rate. So it was really an interesting example where increasingly factors beyond, the exchange rate didn't depreciate because the yields went up again in the US. It didn't depreciate because our fiscal deficit was higher than what people thought. It depreciated purely because of geopolitical risk. And it's much easier to say, well, the current account deficit is higher. We can understand why the exchange rate will depreciate. Maybe it will kind of react for a day or two and then come back to normal. But when you're dealing with the relationship between geopolitical risk and the exchange rate for an emerging market, it becomes incredibly complex. And all I can say is that the challenges of monetary policy are going to be much harder. We have to analytically think about how we distinguish between what is transition, what is not, how much of the trigger is political, how much of the trigger is macro fundamentals. Those are the complexities we're dealing with. Thank you.
Thank you. Let me see, first of all, if there is any question more on this second topic of conversation that we are having. No? So maybe I will follow up on that. And forgive me, but I work in the world of reserve management, so I need to ask about dollar, de-dollarization, BRICS currency, BRICS plus currency. I need to put this on the table. So it's pretty, my question here, I would like to tackle this from another perspective. So it's pretty obvious when I talk to emerging markets, central bankers around the world, I feel this desire of moving away from this US dollar cent. So there is a demand there saying, we can have something different. And if I put together the initiative of South Africa, the BRICS Plus, there is this desire. But then when you actually look at the reality is actually, I see the opposite. When I see the investment behavior of central banks around the world, and that is about the dollar. If you look at what happened in the last few days as a result of the conflict in Israel, immediately you have yields coming down in the US. Why? Because the Asian central bank, Asian investor, demand the US Treasury because they see it as a safe haven. So my question is a little bit provocative for you, but from your perspective, do you think that in the light of the resilience that we discussed about it, in the fact that in the end, emerging markets have not been doing so bad, and this happened in a world which is dominated by US dollar, think about capital flows, would have been different if we were in a world where you have more currency fragmentation, I don't know, multipolar, however you want to call it? And I think it's the right question to ask if you're a central banker and you want to move beyond eventually a US dollar-centric system. And I'm very happy to hear your opinion on that. You go first.
Thank you. Yeah, I think de-dollarization clear is the trend. With the sanction, everybody have to think about how do you deal with the currency risk? How do you dealing with your payment system? How do you deal with international settlements, all those issues? Because those are really, really vital issues, not for monetary policy, but for the whole economy. So I think the shaking the confidence of a dollar start at that ever moment. But it's a long process. It will not done overnight, a year, even decades. It takes time, but you will see the confidence is shaking and on dollar side. I think that's one thing, but it will take a long time because dollar remains the major global reserve currency and also on the class payments also. Yeah. I mean, it's clear. But the second issue is, along with the confidence on dollar, there will be a confidence on US Treasury bill. We observed in the past few months, the market supply and demand on Treasury bill changed. So that's the yield of the US Treasury bill is so high, 30 years particularly. I think that will continue because US debt is way high and the US will continue to issue debts. So the questions with US debts over roughly 33 trillion, 125% of GDP, it's like a go back to sort of the 1970s when dollar decoupled with gold, right? So the short-term issue is really on the bonds market. See how much demand supply will change on the bonds market. So it will change the dollar issue. Because the real issue to support the dollar become a global currency is a US financial market, it's a bonds market.
You mean this impact is already visible? When you say short term, you mean it's already what we are witnessing in these days
I think
for the rising yields in the long-term curve, after the curve?
I think so. I think the U.S. bonds market will be very sensitive in the next 12 to 24 months.
Thank you. I see no alternative that short term for the dollar. Capital controls in China. Even when the States were protecting the central bank for any potential embargo, we have tried to put money in China. We're not protected against those embargoes. They want a treaty with Congress. It's more complex. In the case of the euro, the problem is what euro? In the sense, Italy is paying less than probably the credit rating because they are in the euro, but they are paying more than Germany. We see a signal that markets do not believe that they will be always safe in a certain way. So there is, you have the euro, but you have a lot of countries there. Of course, Germany is the anchor. So it's not so easy to move around. And probably for the next years, I don't know how much, 10, 15, 20 years, the dollar still will be dominant. It's almost 25% nominal GDP. For these things, nominal GDP is the important thing. In financial markets, they are still pretty important. They are, I believe, a little more than 50%. So it's very hard for it to be replaced in the near future. Of course, the concern after what they have done with SWIFT, the European countries trading with Iran, Russia, central bank, of course, a lot of countries are concerned about that they might be affected by the political decision. What was being commented by the South African Central Bank, just an accusation of Egypt, it makes you afraid. The currency was depreciated because you don't know the reaction that the American authorities might have. Of course, that is a deterrent, but we don't have still alternatives. No?
So I guess the exorbitant privilege of the dollar comes less from trade than it comes from everyone holding dollar assets like treasury bills and bonds. But being a co-chair of the BRICS Finance Committee currently, I think that there is a bit of a disconnect between the politicians and the economists and the central bankers. There is also a disconnect between the central bankers and the private sector who use dollars in their trade, not because they have any particular loyalty to the U.S. It has network effects. It makes a lot of difference. I think on the reserve side, what's very interesting is, many of us have a mix of internal portfolio managers and have a mix of external portfolio managers. The interesting thing there is that there has been lots of diversity, and certainly looking at our reserves, which I chair, so I look at it very closely. Our reserve, there's been diversification, but the casualties in the diversification is not the dollar, it's more the euro and the pound. So, the dollar has a portfolio manager is looking at diversification, the usual story into Korean won, Danish kroner, Australian dollar. So the diversification in a lot of the emerging portfolios that I see are purely driven by economic considerations. You're getting good return on the dollar, you're getting good return on some of the non-traditional currencies, and the euro and the pound is occupying a less premium place in it. So I think that as far as reserves are concerned, the dollar will drive it. If the dollar becomes less attractive, portfolio managers will move in a different direction. So that's for me, the critical thing. Let me stop there.
I like this disconnect between politics and finance, because the BRICS currency, for instance, just to be blunt, it sounds like more a political idea. When the finance minister or the more economists met, they realized that actually it's technically very complicated. So I think we have left around 2 minutes, and Christian, I see him raising his hands, and I'm sure it's going to be a good question. Let's see.
I wanted to ask on this issue of the dollar, yeah. So, there is a problem with the weaponization of the dollar. That you may wake up one morning and then your reserves have not only been frozen, but they get confiscated. Yeah, very bad. Yeah. And then also you're funding the U.S. current account deficit. So that's not great either. Yeah. So it seems to me that like the dollar as a reserve asset is a bit like a chocolate bar. Yeah. So you know it's bad to stock chocolate bars, and it's also bad to eat chocolate bars. But when you're stressed, there's nothing like a chocolate bar. You know, that's exactly what you need. Yeah. So you know, what alternative is there, and what are you doing in the context of the IMF to build an alternative? I mean, the BRICS currency, I think, is very far away. Yeah. And you know, it's not clear. But what about making SDRs more usable as reserves for your countries? Are you discussing that in the IMF?
I think that's a very good point. The answer to your question is our governance issues in the disconnection between politicians, central banker, and the market. So the three parties behave in a very different way, based on very different principle. I think that's the reality. I really like your energy and framework. Go back to 1944. Keynesian proposed a universal global currency called banker, right? And he also assumed further, based on universal currency, they should have a universality reserve assets. Obviously, he did not win because Mr. White is much more stronger. White believed dollar is the king after World War II, pound is weak. So then the Bretton Woods system starts. But after so many years, one thing is very clear. Use one nation's currency to serve as an international currency to manage the liquidity and assets, not necessarily a good thing, because they have a potential conflict of interest, as a Triffany dilemma made this very clear. So I think when the dollar becomes weaponized, more and more people now think about whether we can and we should go back to 1944, rethink about Keynesian.
Thank you. I can see 0.00. Just to mention that, anyway, I like the quote of the chocolate. Definitely I will use it, I can tell you already now in the future. But, I mean, just to mention this, what happened in the last few days about the dollar is there. Nobody took up my question whether emerging markets would have been more resilient if we were in a non-US dollar dominated type of financial system. Let's call it multipolar. Nobody take it up because there is the whole question of who provides the liquidity. Eventually something happens. So all this question needs to also be put on the table. But anyway, I just want...
But if I challenge you,
challenge me, please.
I like gentleman's question. If it's when we think about multiple currency world,
Yep.
right, whether we'll provide stability to emerging market. But the question could be, if you have something like IMF, SDR-based
Yeah.
universal currency and reserve assets, the question whether that will provide stability to the emerging market. The answer is
No,
yes.
I think absolutely, but I think it's also a question of how realistic it is, which is very important. But let me finish. There is a parallel here between politics and finance. There is always this view that we enter this new phase of the world since the US in some way gave up his leadership role or his sort of role as the cop. You can call it in different way. I wonder if also in finance there is a danger that if you lift the role of the dollar, then maybe the world is more disordered and is more complicated. It would be more chaotic, like it is, we might say, in the political terms. Anyway, it's a topic I'm sure we'll discuss in future events of Reinventing Bretton Woods, but let me thank you, the panelists. I think it was great for me to hear the views, and really thank you very much.